Okay, so we're going to go ahead and start chapter 1. So we're going to go through a lot of terms. And a lot of these terms are what you're going to see throughout the semester in the chapters. So financial accounting. So that was the first class that we did, and we kind of reviewed the financial accounting. So when we put together our information in financial accounting, we're pulling all the information into financial statements, primarily to give to external users. Go ahead and tell me. And those external users will look at the financials and they'll make decisions off of that. It's different decisions. It could be management, internal as well, but you have external people that are going to be looking at all of those financial statements. So in managerial accounting, we're going to be focusing on information that's going to be provided for the managers within the organization, so internal users. And we will look at financial statements, but we'll also talk about some of the different methods that they'll use to come up with a cost, or deciding how to make decisions based off of those reports that are given to the different departments. So that's what the managerial is going to be focusing on. So also it's a lot of similar things that accounting students learn in cost accounting. So if you have a friend that's in accounting and they're doing cost accounting, they could probably help explain some of this if you are confused on any of the problems, because they're learning it in cost accounting. This one's just a little bit, I guess it's just less detail, doesn't go into as much, so they should know how to help. Okay, so we have purpose of cost classifications. So we want to assign costs to cost objects. This is spelled incorrectly. We'll have costs coming in. We want to figure out how do we want to capture those costs. So let's think about, maybe we'll use the example of automobile manufacturer, because that's pretty easy. Everybody understands there's multiple things that goes into making a car, and it's got to go through a process with all these different pieces and parts going in. So we're going to have to figure out how to assign costs that are associated with certain things to those objects that are going to be going into the automobile. Then we have accounting for costs in manufacturing companies. So we're going to talk about that. Preparing financial statements, which we talked a little bit about in the first 2 classes. We refreshed. We're going to be looking primarily at the income statement. How does the income statement look for internal users, looking to see what their costs are for different things that we're going to be talking about in this semester. So we'll have different reporting that what external will see and managers see. Okay, so predicting cost behavior in response to changes in activity. So sometimes we'll have activities that we're looking at and we're reviewing to figure out how do we want to capture the cost. So we have a machine that's producing something. We want to know, do we want to use machine hours? That might be better than using labor hours. So you're going to have to make decisions based on some type of activity to know what's the cost going to go in. So is the cost behavior better if we go this way or this way? Making decisions, obviously, you're looking at the reports and you're going to be making decisions for the, for the company, so that you can decide what is the best, road to go to help reduce costs, produce higher profits. So that is the goal of looking at all the costs, so we can figure out how can we make things more efficient? How can we be more profitable? Okay, so when we're assigning costs, there's 2 costs that you have to look at. Direct costs, so those are easily identified. We can trace them into an automobile. So think about, like, I think we're going to talk about the example of a car with radios. So think about that radio. The radio went from here and went into that car. It's very easily traceable. It may have a serial number on it. All the different parts that go inside the engine, same thing. They probably have serial numbers. It's real easy to track that going on to what car did that go on. A lot of the cars have their own stock numbers, is what they call them. So when those cars are coming through, you have all these pieces and parts that are going on to this particular stock number, and it's unique to that car. So it's very easily to trace these items. If I'm working in the plant and I'm working on that car, I can say I was working on stock number 1011 all day today. And so I can track that very easily. That's my direct costs. Okay, then I have my indirect costs. These are things that we have to pay for, but we can't necessarily say it went to this car or that car. It's not a product that we can follow. So we have to figure out how are we going to allocate those costs? What are those costs? And then we have to allocate them too. So we call those manufacturing overhead. Okay, so three things. We have direct materials, direct labor, and manufacturing overhead. And that is what we're going to be focused on a lot throughout the semester, is those three things and how they come in, how we cost these jobs. Okay, so we talked about the direct material being raw material. So that's just products coming in that you can track. Sometimes there's pieces and parts that you use that aren't easily traceable. So I worked for an AV, and on the AV industry, we did installs of all this AV equipment, projectors, screens. We did the interactive boards, we did video conferencing, conference room setups with these touch panels. So there's a lot of pieces that go into it that are big, and you can identify them. So this particular item is a smart symposium. It has a stock number that goes along with it, and it's very easily traced to a job or to a product, right? Same thing for this projector. We know this projector went into this room, and we can identify it very easily. But when we start talking about like the manufacturer overhead and these other little pieces that we can't identify, so think about cables that are running through the walls and through. They're using data cables, they're using HDMI cables, and they're running all these things. We don't have a stock number on those. You know, we don't have exact numbers on what went into that. So that's what happens also with manufacturing. So you have companies sometimes that can't always identify exactly this piece or that piece. Does that make sense? Right? You have these little things that are going into it that help make this product work or make this system work. But we have to figure out how we're going to allocate the cost for that. Are we going to estimate like per foot for cables and say, okay, well, this is how many feet we estimated that we used on this job, and that's what we bring out. Sometimes you have leftover, but that goes into your over and under on your jobs. We also have that labor, and we talked about that a little bit with the direct labor, where I'm working on a particular product or a particular job. So if I'm assigned to come out and install the equipment here in this room, I can identify the labor was for this job. So when the timesheet comes through, what happens is it's assigned to that job. So a lot of times when you're working for an organization and they are providing a service for something with products, you're going to have job numbers. So this could, you know, go for the marine industry, car industry, or AV, for any type of service that has a part. So when they go out, the employees will reference those job numbers. I was on this job for 8 hours today. Maybe tomorrow I finished up here on this job 4 hours, and then I went and started a new one. So I have another job number for 4 hours. Those get identified into the system. That way you can pull them in to the job. Okay. So we have our manufacturing overhead, which has our indirect materials, which we talked about, indirect labor costs. You're going to have people that are working sometimes that you're paying for that are not really actually on a particular job. Think about a project manager. Project manager may pop in and out of different jobs, and they're kind of overseeing. So you may allocate that in different ways, kind of indirect. Then we have things like depreciation. So we talked about depreciation expense. You remember what that is? It's on what? What do we depreciate? Equipment. What kind of account? Yes. So we will depreciate our assets, our plant assets or our fixed assets. There's different terms you can use for it, but we'll depreciate those. So you'll have those costs. You'll have property taxes. So my husband works for a plant. He works for Cornerstone, which actually is the one that had the big explosion today on the West Bank, if y'all heard about it. I did not. He called me and he says, I just wanted to let you know I was okay. I'm like, okay, what does that mean? You're okay. He's like, well, there was an explosion at the plant this morning. I just wanted to let you know I was okay. I was like, all right, well, I didn't know about it, but, so anyway, he works at Cornerstone. So it's a chemical plant. So things happen. Sometimes, they have those types of things, but think about, like what they're doing. They have different sections of the plant making different products. And sometimes those products will come off and they'll make something else with the products that the byproducts is what they call them that come off of those products. Well, they also have a corporate office, and the corporate office has human resources, some management that are over there. And so there's rents there that you have to pay for their offices, but there's also rent that they have to pay on the plant, right? So manufacturing overhead isn't necessarily corporate office, but it is the plant. So the plant's going to have all these utility bills coming through, and you're going to have, your property taxes that you have to pay on that location. You're going to have different things that are associated with the plant rent to keep it running. So those are your manufacturing overhead costs. Okay, insurance. I didn't mention insurance, but insurance. Okay, so we have direct material, direct labor, manufacturing overhead. Those three things. They can be broken down into prime cost, which is your direct material plus direct labor. And you have your conversion cost, which is your direct labor and your manufacturing overhead. So there may be a real simple question. What are, what's the prime cost? And they'll tell you what your direct materials is, direct labor, and your manufacturing overhead. Just remember what direct prime costs are, that you have to pull direct labor, direct material, or it could ask for your conversion costs. So you'll have little simple problems like that. And you'll have those in the homework. Okay, then we have non-manufacturing costs, which we just talked about a little bit with the administrative office. So the administrative office, since we talked about that, let's just go back there for a little bit. So that is all the general management of the organization. It can be direct or indirect. So maybe there is, in like my husband's plant, they make melamine, and the melamine department is going to have management. They're going to have several managers that oversee that particular part of the plant. And so that manager can be costed to melamine because that's all he does, 100%. They can allocate him directly to that division. But if they're in asset, they wouldn't go there, right? But I can identify who's in asset and I can cost them out. But you may have a manager that's over all those managers and oversees several parts, and maybe they are a little bit indirect. So you have your administrative costs. So that's why it's saying it can be direct or indirect. We have selling costs. Well, if we're producing something, we do want to sell it, right? If you build a car, you're hoping you're going to sell it. If you are producing t-shirts, you're hoping your clothes are going to sell, right? Shoes. Did y'all have to take, what's that? I think it's called like a CapEx class. Have y'all taken that yet? I think it comes in senior year. It's like a business class where you work with a team and you have a software that you use, and usually it's shoes. It's a manufacturer that does shoes, and you have to figure out like how to sell them in the market. Y'all haven't had that class? Or heard about it? I wonder if they got rid of it. I thought it was all business students, like all, because I was in accounting and had to do it, but I thought I had business people in there. Wasn't just accounting. Don't have that anymore? No. Oh, that was a good class. We had a whole software simulation. We had to run like this, shoe manufacturer.
I did do something like that.
And sell shoes, and you had to work with a team. I didn't understand anything, but the guy that I was with was really good. Thank God. So, because the decisions that he was making was not what I was going to make, but he actually did pretty good. And he didn't care what I said. He was doing what he wanted anyway. But he did good. That's the only bad thing about working with teams. Y'all want to work in teams?
It was hard during the pandemic to do. It was hard.
I'm sure, because you can't be in class, you can't be close to people. God forbid you sit next to them and talk to them, because something might happen. But it's it's good because it's a simulation of how it is when you get into the real world. Obviously, you're not going to be sitting at your desk by yourself and no interaction with anybody. You also, the other thing with testing, I realize we have to study and test and everything, but you always have everything right at your fingertips, all the resources that you need. You have people, you have books, you have internet, you have tons of resources. So don't be afraid that when you go to work, you're going to have tons of resources. You'll have ways to find out information. We use Excel a lot, and sometimes there's things in the formulas that I forgot or just I don't use all the time. So I'm famous, like, oh, I need to know how to do this. I need to do a mail merge for, you know, Word and Excel, and I haven't done it in 2 years. I'm like, YouTube, look it up and it gives me exact directions on how to do it. I do YouTube a lot to get information on how to get my tasks done. But anyway, so I can't believe I don't have that class anymore. That was a really good class. It was one of the last things you did when you were a senior, and some of y'all are seniors, so I'm sure you would have heard about it. Okay, so product cost includes all the costs that are involved with acquiring or making a product. So they're attached to the unit as if it's purchased or manufactured, and they stay attached to each unit or product as long as it remains in the inventory, awaiting sale. So what that means basically is, as I'm building out the car, I have costs that are going into it and I'm putting it to that stock number. Well, at the end, when we'll talk about this a little bit, we're getting ready to get into it. At the end, I'll have a finished product. Well, all those costs are going to stay with that car. Okay, so we have the three things. We have raw material that we start with. We have a work in process, and then we have a finished product. And then we have cost of goods, which is another one because cost of goods is where it goes when you sell it. Y'all remember cost of goods from the first class? Talked about that. So the cost of goods is, it's similar to an expense. So it's gonna offset your revenue. So when you sell products, you'll always have a section that has cost of goods because it's not just an expense, it's a cost that went into a particular product. So if you bought the product, that product, and this is what you learned in the first class, you buy the product, then the product has a cost associated with it. You may have insurance, you may have shipping that gets tacked onto it. So you have a price for this particular item. And when it goes through the process using that item, that cost is going to go along with it. So in this process, we're not just going to sell that part. This one, we're going to have to use it, bring it in with other components to make something and then have a finished good. Okay, so we're going to talk about that. The transfer of the product cost. So right here in the first, I put it in boxes because I thought maybe that would help a little bit. So what did we talk about? We had those direct materials, we have direct labor, and we have manufacturing overhead. So we have all of these costs that are going into items that are available for us to use. So I need all these pieces to build this car, and I need these people to help me do it. So all of that is kind of like loose in all these different little departments where you keep track of things. Raw material, you're going to have inventory, right? You're always going to have to keep track of inventory. We learned about inventory in that first class, how you keep track of the inventory, you purchase more and all that stuff. So you'll have that going on with this raw material. You will have inventory of that product because not everything's going to come out and go into a product that you're building that month. You'll still have some kind of sitting there, right? You're not going to use everything at once. Same thing with your labor. You have your guys and they're doing their labor, but they're not doing it on all of those things that are there, right? They're only going to be doing labor on what is actually getting pulled into a product that's being built. So as we pull these things out, so we have our raw material going out, which is going into our work in process box. We have our manufacturer overhead and we have our direct labor. So we're pulling all these things, pulling people, pulling parts. We also have those indirect costs coming through manufacturing overhead. We have to allocate those costs to the products in order to capture all that. So when marketing's ready to market the item, they know how much markup they have to put on it because they know what the cost is in order for the company to be profitable. If you don't do that and you're not profitable, what's the point, right? So then we have our work in process. So right now we're just kind of going through the process. We're actually going to do some of that transferring with money later of actual costs that are assigned. So now we have our little department called work in process. Well, everything that we bring in for the month, do you think everything gets finished at the end of the month? No, not always. Sometimes, it's the end of the month, but we have time and we're gonna start working on a new car. Maybe we brought in 2 of them already and we finished them and we pushed them out, but now we're gonna start another 2 cars. And so those are starting up. We have these products coming in. So we've transferred it out of this regular inventory. We've started allocating some of the costs for manufacturing overhead. We started having to pay salaries. So now we have costs. So we're moving them into our work in process box. So now they're in work in process through that particular time period, whatever it is that you're looking at, monthly, quarterly, however it's being tracked. So as it's finished, it comes out and it goes into finished goods. So think of inventory as a finished product now. So the car plant has inventory on all these loose items, which is their raw material. And then they have their work in process that they have to keep track of. Where are they in the work in process? There's going to be a cost associated with that because you want to allocate those costs as you're going through those periods. So you have to put those into work in process. And then when it's a finished product, now it's going to come, all those costs collectively are going to come together as a finished good. And here's my car, 10,000 in finished good. So now in the finished good products, I have inventory that I can actually sell now. In my finished goods is my final product. And it stays in there as available for sale. So now we have inventory again, inventory of our finished goods. So as we market these products, now we have a sale. So what happens when we sell those products? We pull them out of finished goods. So they have to leave finished goods and now they have to be put into the cost of goods sold box. So cost of goods sold is exactly what it says. It's the cost of an item that has been sold. And that is my offset to revenue, right? So I have my sales, less my cost of goods, and that gives me my gross margin or my gross profit. Does that make sense? Do you have any questions about how it goes through the process? Pretty easy, right? And we're not going through any of the money parts yet, so that'll come later. Tonight, it's just understanding the concept. So then we have period costs. So think about the period of, how we talked about the period of the operating cycle. You have the month or you have the quarter. You have these period costs that include selling and administration. So once we start having to sell the product, now we start having some expenses that go along with that. Marketing, there's different types of marketing. We may have to have TV ad, we may have to go out into, let's say, the mall, and we're advertising something there. So you'll have costs that are associated with that. Maybe there's particular magazines you want to put it on or different websites you want to show it on. So you're going to have all these different costs and you're going to have to pay people to do that, right? You're going to have a marketing department and you're going to have to pay them. They're not going to do it for free. So you got all of those costs that go along with it. Management that's going to oversee the launch of this product. Okay, so this is from the PowerPoint. I like the little layout of the slide. So this is just kind of a little recap that we just talked about. So we have a product cost, which includes direct material, direct labor, and manufacturing overhead. So remember those 3 things, that's our product costs. And then we have our period costs, which is the selling and administrative. So this little chart just shows you when we have inventory sitting on the books, that's on our balance sheet. Because why? What is inventory considered? What type of account? It's going to be something that's useful for us in the future, right? That we can use this to bring in some profit. So what kind of account is that? Assets. And assets show up on the balance sheet. So remember that formula, assets equal liabilities plus owner's equity. Those accounts are showing up on the balance sheet. So we have inventory, but we have different types of inventory, right? We got to keep track of our raw goods, our work in process, and our finished goods. So we have inventory, that's all on our balance sheet. That is something that we're going to be able to use in the future. And then when we sell the product, Now we have revenue from the sale, and we have cost of goods sold, which is just that cost that's assigned to that product you sold. That shows up where? Income statement. So remember, the income statement is your revenues and your expenses. So this is just another layer. So you have your cost and your expenses on your income statement. So here's our income statement for cost of goods sold, and then here's our income statement for the expense. So it'll be just two different little sections. All right, so let's look at an example. Which of the following costs would be considered a period cost rather than a product cost in manufacturing? So we have manufacturing equipment depreciation. Is that period or product? Think about what we went over a little bit ago. I'm gonna bring you back up and give you a hint. So depreciation falls under what? Manufacturing overhead. And what makes up product cost? Includes, where is it at? Here it is. Okay, so product costs include direct materials, direct labor, and manufacturing overhead. So is that a period cost or a product cost? It's product. Okay, property taxes on the headquarters. That's not really pertaining to the manufacturer. That's, this is corporate. This is considered the period cost because it's going to go with your expenses here. Direct materials, product. Okay, electrical costs to light the production facility. So we're talking about the facility where you're actually building the product out. Product. And then sales commissions. Period. That's part of your expenses of selling that product after it's done, right? You're gonna have somebody's gonna go out and they're gonna sell your product and they're gonna get a commission of it. And they'll get bonuses and stuff too. So think about those salespeople selling cars. Do y'all like going to deal with those salespeople selling cars? Believe it or not, I used to sell cars. I did that for a while. I worked in the car business. That was one of my first jobs when I was very young. I think I was 19 when I got the job. And I worked at the cashier's counter. And then I moved into warranty clerk, which basically took care of all the warranty claims on all the cars that came in. And then I moved into payables and receivables. Then I was a title clerk. So my whole goal was I had gone to school. I had started going to school for accounting. And so I'm like, I want to be like an office manager or a general manager of a car dealership. That was like my goal. But I got frustrated. I was there 7 years and I didn't get promoted to office manager. They put somebody else in that wasn't in the car business. She came from corporate and she didn't know anything. So I got aggravated and I left. But years later, I decided that I wanted to take a break from accounting and go into sales. So I said, well, am I going to sell AV equipment, which I really didn't want to do, or go sell cars? So I'm going to sell cars. So I did do it for a little while, and it wasn't tacky because I sold Audi, Saab, Porsche, and Volkswagen. So it was a nicer dealership. And we had Rolls Royce for a little while. I did not sell a Rolls Royce, but I did get to sit in Lenny Kravitz's Ferrari, but I was not able to drive it because I couldn't reach the pedals. I was too short. And I was like, I never thought I wouldn't be able to drive this car because I'm too short. I couldn't figure out how to push it up. I don't think it went up far enough for me to be able to drive the car. So I don't know. Maybe I was doing something wrong, but I didn't get to drive it. So I did get to drive Porsches and I did get to drive an Acura SX, which was fun. But that was my little window for about 2 years. I sold cars. So when you have these salespeople that are selling products from manufacturers, the manufacturer is training you on their products. They're giving you information on those products. So if you're out into an organization, a lot of y'all are business, some of y'all might wind up in sales, selling products for an organization. So they're going to be training you, sending you different places so that you can get the training that you need to know all about these products. They're going to be telling you how much they're going to launch them for, because you have to know how much it's going to be, right? Because you're going to talk to people about their products. And you're going to have to get yourself educated on the competitors, who you're up against. What does your competition look like? What do they have? What is the benefits of your product over those products? So that way you can get a commission, right? So a lot of times you get commission. So a lot of times car dealerships pay between 20 and 25% commission off of what they make on the cars. And a lot of times it's not a lot on a new car, but a lot on a used car, especially today. I don't know if anybody's tried to buy a used car recently. They're very expensive. My husband's Tacoma, they want to give me more for the trade-in than we paid for it 3 years ago. It's crazy. So anyway, that's my little story. Hopefully it's beneficial in the future. We'll see. I don't know. I don't know where y'all gonna end up. You can end up anywhere in business. I think I told y'all, I have lots of people in my accounting department that have finance degrees and business degrees. Not all accounting people. So you never know where you're gonna end up. Might be in the accounting department doing something that you didn't think that you were gonna be doing. And with business, you can be doing anything, you know, I mean, sales, marketing, anything really with business. Running your own business too. Okay, so predicting cost behavior. So cost behavior refers to how a cost will react to the changes in the level of activity. And we'll have one chapter where we really go through this activity-based costing. So think about like different activities will cause this particular costing method to change in cost, depending on how you cost it out. So we have different things that go into that. We have variable cost. So a variable cost, it varies in total. And why is that? Because with this particular activity, the variable cost will be the same per unit, but what you sell or what you buy or whatever is going to be different. It's really a different quantity. So let's say that we have, I don't know, a piece that goes on a cell phone. So maybe we have like these cases. And so that activity of how many you buy or sell, right, will predict what the cost is. So if I have to buy 1,000 of these, well, the price is always going to be the same. So if I buy 1,000 times whatever I paid for it, let's say $10, so then that's my cost. But then if I only buy 500, it's 500 times $10. So the cost varies, but not because the price changed on the product stays the same. So that's a variable cost. Then we have our fixed cost. So that cost remains the same. But with a fixed cost, the more items that I have, that cost per item goes down because that cost doesn't change. So if I have less items, then it's going to be more per item. If I have more items, then it's less per item, right? Because it's the same thing. And then we have a mix. So that's a cost that just has both variable and fixed cost. And so let's look at this activity base because we're all going to get into that in a couple of chapters. So the activity is going to determine the cost, and it's going to measure what causes that incurrence of the variable cost. So we have units produced. So the more units we have, then that cost may change from that particular activity if we're keeping track of it by that. The miles driven, machine hours, labor hours, so we can use all these different things to allocate costs. So if the machine hours are more or less, if the labor hours change. And so we may say, oh, in this particular case, I found that it's going to be better to use the activity from miles driven to determine what cost I'm going to put on that, because it's an item that we're driving a lot. So maybe I want the mileage because the mileage is going to determine how long it lasts. Not so much the machine, like the machine hours or labor hours. So it depends on what particular item you're looking at and what you're going to do. And we'll get into that a little bit more later. But it's an activity that's going to generate my cost. All right, so let's look at fixed cost. So we have committed, which means that's something long-term. It can't be reduced in the short term. So think about the lease on a plant. We have a 10-year lease. Well, that price is set and it's good for that contract is good for 10 years. So we can't break that contract in the short term. Then you have discretionary. And so that can be altered in the short term by making a managerial decision. So something going into a fixed cost potentially could be changed, and that can be done very easily. All right, then we have the relevant range, which is the range of activity within which the assumptions made about the cost behavior are valid. And so when you look at a chart, the relevant range is always going to be a flat line at where you think that the cost is relevant, okay? So let's look, and this just kind of recaps what we were talking about, this behavior of cost within the relevant range. The variable cost, which we just talked about, is the cost, the variable cost increase, decrease in proportion to changes in the activity level. That means that it's changing because of the activity of that particular item. It's not changing because of the price. So the per unit remains constant. So we just went over that, but I like the little chart. I think this helps. And then we have the fixed cost. So the fixed cost isn't changing. It's affected in the activity level within the relevant range. And that fixed cost per unit will decrease as the activity level rises, and then it'll increase at the end if the activity level falls down short. Okay, so that's a cute little chart that you can use to help you remember. Which of the following costs would be variable with respect to the number of ice cream cones sold at Baskin and Robbins? There may be more than one correct answer. I don't know, Baskin and Robbins. Is that how y'all say Baskin Robbins or Baskin and Robbins? We have a tenant at our North Riverside Mall, and it's Baskin Robbins. It doesn't say Baskin and Robbins, but I have always pronounced it Baskin and Robbins. I don't know. Do you say Baskin and Robbins?
No.
You just say Baskin Robbins?
Yeah.
Really? Oh, something's wrong with me. Good. When they said it, Baskin Robbins, I'm like, wait, no, you mean Baskin Robbins? And they're like, no, Jen. Okay. All right. So which of the following costs will be variable costs with respect to the number of ice cream cones? So the cost of lighting the store, does that have anything with your cones?
No.
Wages of the store manager? No. The cost of the ice cream? Yes, because that could change. How much ice cream you're selling? The cost of the napkins, right? A lot of times they're keeping them napkins behind the counters now. They won't even put the napkins out. They're being stingy, I guess, because of the costs. I can't talk bad. It's probably because of the supply chain issues, because everything's stuck in the boats in California. I don't know if it is anymore. I know it was. I like following conspiracy theories. So I am like, if y'all want to know anything, like I got tons of knowledge in this head about conspiracy theories. I can tell you everything. This has been my little hobby, since COVID started. Chase all the conspiracy theories. But anyway, I do go to the store and buy products. I haven't seen a big difference. I do hear people talking about it's going to be bad. So I have like tons of beans in my house. If anything happens, I got lots of beans. So we're not going to starve. I'm not get sick of eating beans, but we're not going to starve as long as I have gas. Which I do have gas. So when the electricity went out for Ida, guess who was cooking? Me. My daughter's like, I want something to eat. I'm like, let's have grilled cheese sandwiches. We got to get rid of stuff from the refrigerator. Anyway. All right. So this is our formula. And I think this is about as fancy as it gets in this class with formulas. So we have a total mixed cost line, which can be expressed as an equation. And so you'll use this equation to solve your simple little problems that you'll have. You can solve them algebraically. So Y is the mixed cost. A is your total fixed cost. B is the variable cost per unit of activity. And then the X is the level of activity. So if I said that I had a fixed cost at this ice cream shop, you know, the rent's $1,000. So it's $1,000 for the rent. That's not going to change for the month. And then I said I have, you know, $10 per tub of ice cream. And then I have 50 tubs that were sold for the month. So you would just plug those numbers in to figure it out. Okay, and that little chart's just showing you utility costs because it does use mixed costs when you have utility fees. You have a fixed amount and then you have some activity, you have usage. And so we do a lot of analysis on the usage of our energy bill and our buildings that we have. And I'm gonna tell you, the energy cost has increased 21%. So we have a huge, like, so at the mall, usually that runs about $600,000 a year for electricity at the mall. And this year it's a lot higher. It's like 700 and something thousand. Like, why is such a big difference? And I'm like, well, it's 21% increase in the rate. The usage actually went down slightly, but there's different ways you can do analysis on things like that. Okay, so if your monthly utility charge, this is the fixed charge, is $40. Your variable cost is 3 cents per kilowatt. And then you have a monthly activity level of 2,000 kilowatt hours. What is your utility bill? So then you just have to plug it in. Okay, so we have our fixed cost, which is 40, plus the 3 cents times the activity, which is 2,000. And then we come up with 100. And that's how the homework problems will be too. They'll be pretty simple. Okay, decision making. So we have decisions involving choosing between alternatives. So sometimes you'll have to look at what your goal is, and you'll have to decide, am I going to do this alternative or this alternative? It's just talking about you're comparing those costs. Are they relevant? Are they irrelevant? So you want to know, if I'm going down this path and I need to bring all these costs in to know like what I'm going to make decisions on, I don't want to be looking at things that are not relevant, right? Because we don't have time for that. You're going to have so many things going on when you're in a workplace. You're not going to have time to look at things that are irrelevant. So you want to make sure that what you're looking at is relevant. And then you want to look at these differential costs, your opportunity costs, sunk costs, and we'll talk a little bit about those. All right, so our differential cost is the difference between any of the two alternatives. Am I going to go with A or B? Here's the difference. It could be a new software that you're evaluating to use within the workplace, and they have different, obviously there's two different alternatives. I can go with A or B, and I'm going to have some kind of variance in the cost. And so I need to decide what some other factors maybe that will be relevant, but those costs that are going into that are definitely relevant in making my decision. Okay, so you want to know that there are going to be two different alternatives potentially, and those can be relevant to the decision, and they're also going to be either fixed or variable. So in software, potentially it could be variable with how, like, think about payables. So right now, a lot of payables departments have their invoices automated. So when I teach the other class, principles, and we talk about payables, I go into the payables department. What does that look like in a workplace? So now it's no longer keeping track of things on the ledger. We have the computer system, we're taking some sort of source document, we keep punching it in. Or maybe you're looking at a new software that's going to take that and scan it. It's going to go right into the computer on its own. So we have a fixed cost that maybe is going to be for just having this particular type of service. But then the variable cost could be how many documents are going in, and that's going to add, because it's going to be per document. So if I have a lot of documents or less documents, that will determine my cost. So maybe that software does that, but then I have this other software that just charges a flat rate. Doesn't matter how many documents you want. So you have different things, different options, two alternatives, right? And they're relevant. They're both relevant to making that decision. So you'll have a lot of that happens when you're in the workplace. It could be fixed or variable. Then we have opportunity costs. The potential benefit that you're giving up for one alternative is selective over another. So there's always opportunity cost in every decision that we make. Tonight, coming to class, you had an opportunity cost. So what are you missing out on because you're here? You know, that was an opportunity that you could have had, but now you're here learning instead, which is going to pay off. So stay in school. Finish. I didn't finish first go round. I took a break, 15-year break, but I went back and finished. I did go back and finish. And so I did tell y'all I have both my degrees from here. And I finished, so 15 was the bachelor's in accounting, 16 was the tax master's, and then 17 was the CPA. So it was like boom, boom, boom. But it wasn't that long ago. So that's what I was saying. I'm familiar with some of the teachers. A lot of people left though since I was in class. Thank God y'all not in accounting, because Dr. Ban was pretty hard. I don't know if y'all have any accounting students that y'all know. He's hard. I don't know who's hard in business, but this guy was a challenge. Okay, then we have sunk costs. So the sunk cost is a cost that already has been incurred and that cannot be changed now or in the future. So it's something that I've already invested in and there's nothing I can do about it now. So let's say I decided that I was going to invest in Bitcoin and Bitcoin was, doing great. It was really high. And so I put some money into it and I don't know how it works because I don't do it. My husband does, but it was like 50,000 per coin, I think it was. So like when you buy in, you're getting like a piece of a coin. And I don't know what backs this up, but there's supposedly mines in China that have all these whatever that's backing the money that's going into Bitcoin. I don't know if y'all understand it better than me, but that's what I understand. So if I decide that I'm going to invest while it's 50, because I'm thinking, oh yeah, this stuff's going up and I'm doing really good, I'm going to basically just sink my money into it. And then what happens? It starts dropping. Now it's like 30. I don't know where it is today, but I'm saying it was at 30 at some point. And I was telling people, get out, get out. I heard somebody say Bitcoin's going away, like get out. My friend has a ton of Bitcoin. So what happens? I dumped all that money and that's my sunk cost. It's gone. So do I make a decision to sell it now? Well, it's at 30, or do I wait and hope that it's going to go back up, or do I wait and then I have nothing, right? I already sunk that money into it. So that's my sunk cost. Can't change it. All right, suppose you're trying to decide whether to drive or take the train to Portland to attend a concert. Don't go to Portland right now, it's not good. You have ample cash to do either, but you don't want to waste money needlessly. Is the cost of the train ticket relevant in this decision? In other words, should the cost of the train ticket affect the decision of whether you drive or take the train to Portland? So what you think? So if I want to decide between either or, should I think that I should know what the ticket costs? Yeah. Okay, so same example. Suppose you're trying to decide whether to drive or take the train to Portland to attend the concert. You have ample cash to do either, but you don't want to waste the money needlessly. Is the annual cost of licensing your car relevant to this decision? No, because you're gonna have to do it anyway, right? You're gonna be driving, but it's not pertaining to that decision of going to this concert. You're not gonna say, no, I'm not going because I gotta pay for this. Well, maybe if you don't have any money, but they say you have ample money. All right, suppose that your car could be sold now for $5,000. Is this a sunk cost? What I can sell it for now? No. What's the sunk cost? What I paid for it, right, before. So maybe I bought this car 2 weeks ago and I don't like it. And I paid $10,000. I can only dump it for $5,000. Well, the $10,000 would be your sunk cost because you've already done it. You can't change it. All right, the traditional and contribution formats. So this is what I was talking about earlier with the income statements. And we're going to be out even earlier than 7:30. So the traditional is what we learned in the first class. So we have the sales, which is our revenue coming in. Then we have cost of goods sold. So this is everything that we moved into finished goods and now we've sold that finished good. That goes into cost of goods sold. And then we have our gross margin, less those selling and administrative expenses to get our net operating income. So that's what we would show on our format that we would show to external users of financial statements. But internally, we may want to know a little more information, so we can break it out a little bit different in this contribution format. So we have sales of 100,000. We have a variable cost of expenses of 60,000, which gives us our contribution margin. And I think we go into more of that next week, the contribution margin, doing some problems with that. Okay, so we have sales less the variable cost that gives us our contribution margin, less the fixed expenses, and that gives us our net operating income. So you see it's broken out a little differently. So I'm looking to see, what is that variable cost and then what is the fixed expenses that are assigned to it. So when you, at the end, you have the same net income, it's just shown a little bit differently. It's broken out a little bit differently so that you can make decisions better in that reporting. So that would be used for internal use, primarily by the management team. Okay, so that is all of the information that I wanted to go over for chapter 1. So let's go look at a few of the homework. Hopefully it's still. I guess I can do preview. Okay, so they're giving us some information, and in this particular problem, you have to figure out what's the differential cost, sunk cost, opportunity cost. I don't know that I want to go into that one because it's just going through and grabbing some numbers and adding them together. Okay, so let's look at this one because we have different levels of production. So we have Harris Company manufactures and sells a single product. A partially completed schedule of the company's total cost and cost per unit over the relevant range of 64,000 to 104,000 units is given below. Complete the schedule of the company's total cost and cost per unit as given in the relevant tab below. Assume that the company produces and sells 94,000 units during the year at a selling price of $7.35 per unit. Prepare a contribution format income statement. So we're going to be using that format that's used for internal managers. All right, so it's incomplete, used 2 decimal places. All right, so we have our variable cost. Let's see. It's got selling price $7.35, and it's got our sales at 94,000. I was trying to figure out where does it give me the per unit. We have to figure it out. So I'm thinking that they're giving us this because they're not highlighted in blue, and I don't see anything up here. Okay, so they're telling us that the variable cost is 147.2. They're going to tell you your fixed costs, and that gives you your total cost. So they want you to calculate out how much it is for per unit. So obviously we just take the units, which is the 64,000, right? We take the 147.2 divided by the 64,000 to get the 230. Do the same thing for the fixed cost to get your cost per unit. And that's all you're doing on this step. So each one, you would figure it out based on the units that they've given you up here. So if we have $2.30 per cost, we would multiply it by the 84,000 to come up with our variable cost. And I'll check it just to make sure. So we already calculated out the variable cost, which we know is going to remain constant, right? The variable cost remains constant. It doesn't change unless the production changes, the activity of the production changes. So we increased it. So it's 84,000. Yeah. So you just multiply it and get it. Obviously, fixed cost does not change. It's fixed, it stays. So now we have a new cost, and then you're working out like how much is that per unit. So remember, the fixed cost changes per unit because the cost doesn't change. So as you increase the products, you have more products, so then it's going to go down per unit. So we decreased to 405. And then now we have 104,000. So again, variable cost is 230, multiply it by the 104 to come up with your variable cost. Fixed cost stays the same. And then we calculate it out again, and it's going to go down a little bit more because now we have more units of production. Okay, so you just fill in the table in. So now we're going to do the income statement, and we want to bring over our sales, which it gives us. We sold 94,000 units. And it says that we sold them for $7.35 per unit. So our sales number is $690,900, and just multiply them. And then we have our variable expense. So we are assuming 94,000. So then we're going to have to go figure out what the 94,000 is, I guess. Let me see. So we have the 230 times 94,000. Yeah, so you're not pulling anything from the other chart. They want you to base it on this 94,000. We calculated out what it was per unit. It was $2.30, so you would use that. 690 less than 216 gives you a contribution margin, less your fixed expense, and so then you have your net operating income. Not too bad. Okay, this one is pulling your numbers to a traditional format and a contribution format. So the first one's going to have that cost of goods sold, your selling expenses below. So you'll have to know what to pull in order to put into the format. We have sales. Okay, let's see. Selling price per unit is $16. So we have to figure out, you have to figure out, it probably gives you the calculation down below, but you have to figure out what did you sell. So you have to know how to calculate out your inventory, which we did in principles. So let's go through that just so you know how to calculate that out. So we have, and this, okay, so say we didn't go over this problem in class. You have that practice set. So I think you can check your answers or something in that one, and it'll tell you how to work it out. It should give you the solution on how to calculate it out. So if you're stuck not knowing how to get to a number, you can go to that one and figure out. So we have beginning inventory of 10,000, ending inventory of 25,000, purchases of 87. So do you remember how to calculate that out? We have our beginning inventory. Let me see if I can, there's a way I can write on this. Just gotta figure out. Hit the wrong button, sorry. Annotate, here we go. So we take our beginning inventory, which is 10,000 plus purchases, which is 87,000. So what do I have available to sell? I would take my beginning inventory plus whatever I bought. So that's what I have available that I can sell for that period. And then it tells me my ending inventory. So I have to take the difference to know what I sold. So if I have 97,000 available and it's telling me ending inventory is 25,000. So I have 72,000. Which is my cost of goods sold. So you see how I calculated that out? So you're gonna have to use these numbers right here to figure out that number. Let me close that out so I can move around. Okay, so the sales is 208,000. So I have to calculate that out. I'm selling, my selling price is 16. Let's see down here. I got my 13,000 units and it says it's 208,000 when you do the calculation. Okay, and then we have our cost of goods sold, 72. The gross margin is 136. Now we have selling expenses. So you go back up here to determine my selling expenses. So I have total fixed selling expenses of 19,000, total fixed admin expense of 14,000. But then I also have variable selling expense per unit. So I have to add that to the fixed. So just think about that formula that we learned. The fixed cost plus the variable cost, which is per unit and then how many units. So we're going to take the price per unit and multiply it by the 13,000. Okay, so we're looking, I don't know if I can, I got to bring it back up. Let's see, eraser, clear. Okay. So this one right here. So we're going to calculate that variable cost, which is the 2 times the 13,000, which is this part here. plus the fixed, which they gave us, is 19. That's 45,000. So that's how they came up with that 45,000. Then we have to look at the admin. There was a variable admin, which was 1 per unit. So we look at how many units were sold, and then we add the fixed to it to come up with the 27. So those are the two numbers we're using for our expenses for selling and admin. Clear. Oh. Okay. I don't know why it's, okay, there it is. So we have our selling 45, admin 27. So we add those up to get the 72, net operating income is 64. And then we do the other format, which is going to be a little bit different on how we break it down. So notice the variable expense is up here. And we'll calculate them separately. So we have the variable up here with the cost of goods sold. And then you just deduct and get the 97,000. And then at the bottom is just what they gave you for the expenses, the 19 and the 14, which is the fixed. Okay, and get net operating income of 64. And then it should match. Okay, we're not going to do that one. Let's just going through and reading and selecting the type of cost that it is. I can do that one. This one looks similar to what we just did. So it's telling us our variable costs in the problem, telling us our fixed costs, and then it's giving us the number of units at the top again. Let's see. So that one's similar to the first one that we did. This is filling out the information on the spread, on the income statement. Same thing we just did. These are some of those easier questions, just getting you to know what that was and then being able to solve the problem. I think that you should be able to figure out those. All right, so this is calculating cost of goods sold. Let's just walk through this one. On April 1, an automobile manufacturer had no beginning inventories. It purchased 8,400 batteries at a cost of $90 per battery. It withdrew 7,800 batteries from the storeroom during the month. Of these, 50 were used to replace batteries in cars being used by the company traveling sales staff. The remaining batteries withdrawn from the storeroom were installed in cars being manufactured by the company. Of the cars in the production during April, 80% were completed and transferred to work in process. Of the cars completed, 20% were unsold. So how much of the total battery cost would be in the cost of goods sold? So we got to figure out, we got to go through the process of the batteries to figure out what it is. So we start with 8,400. Let me just go down here and see if they don't show you the calculation for the 8,400. No. Okay, so we have 8,400 batteries. And it's saying that I withdrew. So out of that, I'm taking out 7,800. So this is what I'm working with right here. It's saying 50 were pulled out to use on cars with the sales staff. So we're not selling those, right? We're just using those for us. So we're going to take those out. That's how they come up, how they starting down here, actually. Okay, then it says, of the cars in production, 80% were completed. So this is our work in process, right? We pulled these out. Now we got to pull out 80%. Got to move those out. So we need to figure out how much is that 80%. And then it says the cars that were completed during the month, 20% were unsold. Well, I'm trying to figure out what my cost of goods sold is. So am I gonna multiply it by the 20%? No, because I don't want to know what the unsold was. I'm gonna do 80% because I want to know what was pulled out. So I'm deducting out that 80% again. And that gets pulled out. Okay, so here's the calculation right here. So we have the 7,800 minus the 50 units. Then we're gonna multiply that by the 80%. Then we're gonna multiply that by the 80%. And it comes up with this 4960. So let's just work it out so you can see the numbers. It might be a little easier. So 7,800 minus the 50. So we have 7,750 times 80% that we complete. So 6,200 moves out to my finished goods. Now, in my finished goods, it tells me that I have 20% left. So 80% was sold. So I'm going to do times 80. So that's where the 4960 comes from. Okay, does that make sense? And you may have another question in there just like this, but it's asking you what the selling expense is. So all that is this 50 units right here, right? Because that's what we pulled out for the sales team. So that would be the 50 times the $90. That would be my cost for the selling expense. Okay, so I know 4960 is my units, and it tells me $90, so I just multiply it to come up with a number. So just be careful what it's looking for, because there may be one that says the selling of that. Okay, so do y'all have any questions?